Good afternoon, everyone. This is Christian with PerfectStockAlert.com, a 100% free service for smart investors and traders. All we ask in return, please refer a friend. Today we're going to be looking at the definition of negative goodwill. As we do in each one of these fundamental analysis tutorial videos, I'll give you the actual definition, and then we'll go on to look at an example and give you a little more insight. Negative goodwill, also called a bargain purchase amount, occurs when a company buys an asset or another company for less than its fair market value. Negative goodwill is the opposite of goodwill. Now let's go look at an example and make this perfectly clear. For this example, we'll be looking at the Walmart Stores Incorporated balance sheet, and negative goodwill is a contra account that will be found in the liabilities section, long-term section of liabilities. At the very bottom, and right here, you can see negative goodwill. You'll notice in this case, as in most cases, you'll see nothing listed there. There will be no actual figure, no number to be reported. The main thing to understand about negative goodwill is that you cannot understand unless you first understand what goodwill is. So let's go up here to the long-term assets section and look at the goodwill right quick, and you'll see that there is a number here. Goodwill comes into play whenever a company purchases another company and they pay more than the net fair value of their tangible assets. Goodwill is also known as blue sky, because you're paying over the actual fair value of the net tangible assets. And that happens most of the time. When a company's purchased, you're buying up all their assets plus the intangibles, such as the name brand and that kind of thing. And that's why you get a price over the actual fair value of the net tangible assets. In these cases, when you see that, like I said, in most cases you will see goodwill reported whenever one company purchases another company, and the acquirer, the parent company that actually purchased the other company, will show goodwill in the amount that was over and above those net tangible assets. In some rare cases, a company will be acquired for less than their net tangible assets. So let's say you have company XYZ out there and it has $10 billion in net tangible assets, and Walmart comes along and they buy that company XYZ for $5 billion. Well, in that case, they've actually purchased it for less than its net tangible assets, and that's an extra $5 billion of gain there that they have to then report. It would show up on the company's income statement, on Walmart's income statement, as a gain, and it would be written off not immediately but over time. So as you start to write that down, you would start showing on the income statement. But that extra $5 billion that they actually gained would go right here, and then it would begin to be written off until the goodwill was zeroed out. And that's basically an oversimplification, but you get the idea of why it's there. It's rare that it's going to be there, and it won't really have anything to do with most of the companies that you look at. But whenever you do see it, in most cases, it simply means that company A purchased company B that was probably in a distressed situation where they had to sell at a disadvantaged price, and they basically sold their assets for less than they were actually worth. It's actually a good thing if you see it. Please take a moment to review our disclaimer. The information provided herein is our opinion only. Under no circumstances do any statements here represent a recommendation to buy or sell securities or make any kind of an investment. You are responsible for your own due diligence. To summarize, we do not provide investment advice, nor do we make any claims or promises that any information here will lead to a profit, loss, or any other result. These videos are for educational purposes only.